Good morning and welcome. We'll get started in just about 1 minute. Good morning. Thank you for your patience. We'll get started in just a moment. Hello and welcome. Today, First Bank Financial Education Center presents Making the Most of Employee Retention Tax Credit. I'm Amanda Dustman and I will be your facilitator today. Tim Fogarty, Managing Director of First Bank Commercial Team, is also on hand. Today, we're going to explore the topic of Employee Retention Tax Credit with our special guest from Brown, Smith & Wallace. Just a quick reminder, the lines are muted, but at any time you can send us your questions through the webinar tool. And keep your mouse handy because you can type those questions in at any time. At this time, I'm going to pass it over to the host of our program, Mr. Tim Fogarty. Go ahead and take it away, Tim.
Thank you, Amanda, and good morning, everyone. At First Bank, we have been talking with many of our clients about the Employee Retention Tax Credit, particularly since the CARES Act rule was retroactively amended to qualify PPP borrowers. Depending on your circumstances, this credit can provide meaningful relief to companies in most need brought on by the pandemic. Today's webinar is intended to make you aware of your eligibility and the benefits of the Employee Retention Credit. For today's webinar, we are again leaning on the expertise of our friends at Brown Smith Wallace. We are pleased to have John Schwartze as our expert presenter. John is an attorney and principal in the tax services practice at Brown Smith Wallace. John brings more than 15 years expertise as an international tax professional. Thank you, John, and I'll turn it over to you for your presentation.
Great. Thanks, Tim and Amanda. Appreciate it. And I appreciate everyone else joining us this morning. I know coming off the long weekend, we have a short work week to get through. So the agenda today is fairly straightforward. We are talking about the Employee Retention Credit. You'll probably hear me refer to it as ERC for short as we talk about it this morning. We'll discuss a bit about what is the credit, who is eligible, how did it evolve, and what does this all mean to you and your business or organization. I also have a brief example or case study to maybe help make sense of some of this, and then I will open it up for questions that you may have. Thanks. So I know some of you probably are more familiar with ERC than others, but I'm going to level set for everyone, including those who've not been exposed to the credit. So what is the Employee Retention Credit? It is a fully refundable payroll tax credit that was designed to encourage businesses to keep employees on the payroll. With this slide, I wanted to take a moment to walk through the evolution of the credit and how we got to where we are. So the credit was part of the CARES Act that included PPP and many other programs. Now, in its original form, back at the onset of the pandemic, you could not claim the ERC if you received PPP funds. So they were mutually exclusive. This is where a lot of people looked at it and said, oh, PPP is way better, and forgot all about ERC and any possible benefit. Well, that all changed in December with the Consolidated Appropriations Act, which retroactively changed the PPP exclusion. So now you can receive PPP funds and the ERC benefit. You just can't double count the exact same dollars. So you can't use the same payroll dollars for PPP forgiveness as you're using for the employer retention credit. Now, in December also, the act was extended the program and made it more lucrative for the first 2 quarters of 2021. Okay, so that's not the whole story. Then in March of this year, well, there was more legislation passed, and which extended the program through the end of 2021. So now ERC is available to taxpayers from beginning of the pandemic all the way to the end of 2021. And in March, they also added a few new rules, which included expanded eligibility to startups and additional help for severely financially distressed companies. So for an employer to qualify, it must meet one of the following tests. Now, this is an OR test. So now some employers meet both tests, and that's fine, but you really only need to meet one of the 2 tests to qualify. First option for the test is the business is fully or partially suspended due to a government order. Now, this can be a very facts and circumstances test, and it must tie back to a government order. Much more qualitative analysis in there than the second option, which is very quantitative. And on the second option is a business experienced a significant decline in gross receipts in any quarter. Now, this is a more straightforward test, but there are some nuances. Gross receipts has a broad definition, includes things like interest income or income from disposals. So in 2020, it was harder to qualify, meeting a 50% decline versus 2021. The government made it easier to decline with only a 20% decline. The decline is always looking back at 2019. So here on this next slide, we're looking at what is a significant decline in gross receipts for 2020. Well, to make things confusing, we have different tests for 2020 and 2021, and there are multiple components to these tests. These are quarterly tests, and the gross receipts decline in 2020 to qualify is more than 50% compared to the same quarter in 2019. So you're looking at what's your gross receipts for second quarter 2020 versus gross receipts for second quarter 2019, third quarter 2020 versus 19. We're always looking back to this 2019 kind of pre-pandemic situation. Now, once you qualify, you don't have to, man, if you go back to 2020 for a sec, once you qualify in 2020, you don't have to meet that 50% qualification each quarter. Once you hit the mark, you stay qualified until the end of the first quarter in which gross receipts are not down more than 20% to 19. So you almost get a buy one, get one free here. If you qualify for the second quarter 2020, you're going to qualify for third quarter 2020 no matter what, because once you're down more than 50%, the government wanted to help you out until you get back to a more normalized level. So and that level is within 80% of what you were doing before the pandemic. So now in 2021, on the next slide, the rules are a little bit different. So they changed the rules and made it where they wanted more people to qualify, easier for people to qualify, and also made the credit more lucrative in 2021. So we, as I mentioned before, we always go back to 2019. So it isn't like looking and saying, oh, you had a bad 2020, you need to have even a worse 2021 to qualify. That's not what we look at. So we're looking at first quarter 2021 versus first quarter 2019, second quarter, etc. Now, one of the most confusing things when it comes to explaining this to folks is this is for 2021 only. You're allowed to use the same quarter to qualify. So like I was saying, that first quarter 2021 versus first quarter 19, or you can elect to use an alternative quarter, which is an immediately preceding quarter to qualify. So to qualify for first quarter 2021, you have 2 options. You can either look at your actual first quarter 2021 versus first quarter 2019, or you can elect to use the immediately preceding quarter, which is fourth quarter 2020 versus fourth quarter 2019. So you always match up the quarters. But if your gross receipts are down more than 20% for such a quarter, you qualify. So I know, take a minute, that's confusing, and it has been for everybody I've explained this to. But again, there can be a benefit to having the flexibility to pick this additional quarter, as we'll talk later when we go through the example. It might allow you to even pick up an extra quarter of eligibility as your gross receipts get back to a normal level. So that was one way. We were talking about that there's two ways. It's an or test. You can either qualify for having those gross receipts being impacted, or if you were fully or partially suspended due to a government order. Well, ceasing all operations, as on the slide, is easier to understand, but a portion of your business or a partial shutdown adds some complexity. Now, the revenue test qualifies your wages for the whole applicable quarter. So if you qualify for the second quarter, all wages in second quarter qualify. Here, if you qualify due to full or partial suspension, it is for the period that your business is suspended. So if your business is suspended for 2 weeks in a quarter, just those wages for those 2 weeks would qualify, not the entire quarter that was affected by it. So the IRS has issued some guidance in the form of frequently asked questions that are on web, and some notices included notice 2021-20 and 2021-23. And one item of note in the IRS guidance is what is more than nominal, because in their guidance they start talking about business operations need to be affected more than a nominal amount for a partial shutdown. And the notice that expanded on the definition and position to say that nominal is less than 10%. So the IRS has given us some guidance saying what their interpretation of a partial shutdown is in needing to be more than nominal. Okay, so what does this really mean? If I'm going to qualify for the employee retention credit in either or with my partial shutdown or full shutdown or a significant decline in gross receipts, what does that mean? Well, for 2020, it is 50% of qualified wages is what the credit is, up to $10,000 in wages per employee for the year. So up to $5,000 in credit per employee for 2020. Now, as I mentioned earlier, for 2021, they made the credit easier to qualify and more lucrative. Well, in 2021, they upped the credit percentage to 70% of qualified wages, up to that same 10,000 wages per employee, so $7,000 per employee. But that cap is per quarter. So you can actually get up to $28,000 in credit per employee in 2021 if you qualify for each quarter. So what do we mean by qualifying wages? So with wages, they treat things differently if you're a large employer or a small employer. The program is designed to help out small employers more than large employers. So the definition, once again, changed. So a large employer for 2020 is an employer that has more than 100 full-time employees. They wanted more people to qualify and thought that small employers should be moved up in 2021. More than 500 full-time employees is a large employer. So what does that mean? So if you're a large employer, you only wages qualify for paying employees to not provide services. Whereas a small employer, all the wages you pay to your employees can qualify. So a simple example of providing service and not providing service is the easiest way for me to think about that. So you have a restaurant that has been partially shut down and are only doing carry out. So the cooks are still doing their normal job, but maybe the waitresses and bartenders are not. So the waitresses and bartenders are not coming in, but you continue to pay them. You want to have them ready to go when the world returns to normal. So you're paying the bartenders and waitresses stay at home, and you're paying the cooks to come in and do the job they always do. If you're a large employer, only wages paid to the bartenders and waitresses not performing services would qualify. The cooks' wages don't qualify as they are performing their normal services. Now, if you're a small employer, all the employees, both the cooks, the bartenders, the waitresses, everybody's wages qualify. So there's a big advantage to being in the small employer definition, whereas being able to, even if you're running your business as normal, all those wages can qualify, whereas if you're a large employer, you have these additional tests to meet to get qualified wages. So when we're talking about qualifying wages that you're paying the employees, what does that all mean? So it's salary, wages, bonuses. I'm coming off my example with restaurant. Tips that they're included in your W-2 qualify, and healthcare costs. So that's this oversimplification here is basically your gross wages plus your employer paid health insurance costs can also qualify as wages. Now, a couple things are excluded from wages, so termination or severance pay is not qualified. And there's some situations that if you furloughed employees, and even though you didn't pay any wages to them while they were furloughed, and you kept paying their health insurance costs for them, those costs can qualify and be treated as, I use air quotes, wages for calculating the credit. Now, there are some other limitations on what wages qualify for the employer retention credit. One limitation is related individuals. So defined under Code Section 51, which references Section 152, is relatives of the majority owners of a business do not qualify. So your brothers, sisters, your niece, your nephew, your aunt, your uncle, son-in-law, those individuals, if they're on the payroll, their wages do not qualify if they're related to somebody who owns more than 50% of the business. Maybe this was put in to prevent people from hiring family to just get the credit. Don't know exactly their intention there, but unfortunately, there is not an exclusion or way to overcome this rule via facts and circumstances. Even if your nephew has worked for your company for the last 10 years and is paid just like everyone else, unfortunately, his wages would not qualify for the employer retention credit. Interestingly, on this list, the owner themselves and the spouse are not listed. There are some disagreement in the tax professional community about if the majority owner and the spouse's wages themselves qualify. The conservative answer is to not include them. But there is a position to include the wages, and that is a decision to make after having a discussion with your tax advisor, considering the technical rules and your personal risk tolerance. Okay, so aggregation is one of the most important rules in ERC and can be incredibly complicated and confusing. And it impacts everything we just talked about. So the aggregation rules combine entities that are treated as a single employer under code sections 52A, 52B, section 414M and O. And they're really aggregating using one of three things. Either treat them like a parent subgroup, like a common parent that owns more than 50% of the subs, or it can be a brother-sister group of two or more entities that 5 or few individuals or estates or trusts own at least 80%, and the same 5 or fewer have identical ownership of more than 50%. Or the affiliated service grouping rules can exist even without common ownership, where the performance of services by one entity for another can cause entities to be grouped as a single employer. The rules are incredibly complicated, complex, and take a lot of time and effort to make sure that we're grouping things the right way. Now, what does this mean if you have to group entities or companies together? If aggregation is required, the entities are grouped for all parts of the ERC, including testing for full or partial suspension, declining gross receipts, employee count for determining large or small employer. Now, sometimes it can be a benefit to group entities, and other times it's a detriment. So taking the partial shutdown, If you have 6 businesses, maybe restaurants again, owned and aggregated together, and one's maybe in a city in California that has been shut down, and others, the other 5, or maybe in the rural Midwest, if that one city has a shutdown and that one entity is shut down by a government order, but the others had no government order, that partial shutdown will actually be applied to the entire group. So we can see that that can be a benefit. So even though that only one of the businesses was shut down, all 6 of them would be treated as such because they're aggregated together, and that partial shutdown would spread to the entire group. For the gross receipts decline, you have to add the gross receipts for all the entities for the applicable periods and compare them. Now, this could be a benefit or not. It's just kind of how the math works out. Also having to combine head count for large and small employer. Back to that 6 company or restaurant example that I was mentioning, if each one of those employed 90 employees, then when you're grouped together, you're going to be treated as a large employer because all 540 employees would be counted together on that test. You're not going to be able to peel out each one individually. So on to the next slide here. This was kind of, I know sometimes I talk fast, we're covering a lot of information, especially if this is the first time you've been exposed to it. This is kind of the cheat sheet summary of what the rules are in 2020 and 2021 and what do those amounts really mean. So for 2020, the credit, as we mentioned earlier, is equal to 50% of those qualified wages, up to $10,000 per employee for the year. So in 2020, you could get up to $5,000 per employee for the entire year. A lot of money. I mean, even if you're a small shop, if you have 20 employees, we're talking about $100,000. It can be a big benefit. In 2021, the credit is equal to 70% of qualified wages, up to $10,000 per employee for each quarter of 2021. So here, employers can receive up to $7,000 per employee per quarter. And that's a huge difference between 2020 and 2021, is being able to use up to $10,000 in wages per quarter. So if you're paying somebody more than $40,000 in the year, you could get a benefit of up to $28,000 in 2021. The other thing is what I talked about, they made it easier to qualify in 2021. Instead of having to meet that threshold of that 50% decline in 2020, in 2021, it's only a 20% decline. I have some clients that it's just lumpiness of business. I have one construction client that second quarter 2019 was the best quarter in the history of the company by far. Well, second quarter 2021, it looks like they're going to qualify just because they're going to be down more than 20% compared to that quarter. And then the other thing we've been talking about is being treated differently if you're a large or a small employer. So if you're a small employer, there's a huge benefit there, as I've been talking about. So you can just be running your business as normal. You get to pick up the wages for everybody on the payroll can qualify. Whereas opposed to if you're a large employer, you have to look at, okay, am I paying these people not to perform services? And working with clients and talking to people for the last 6 months, very few people did that. And if they did it, they didn't do it for very long. Paying somebody not to perform services isn't something that a lot of employers did. So one thing I wanted to mention here as well is, okay, this is great, I qualify, you're telling me all these numbers, how do I get my money? So it is a payroll tax credit, and that can be claimed on your timely filed 941 or 941X, especially when we're talking about 2020 and the retroactive changes, and we're past first quarter 2021 now, that you can file 941X and to claim the credit and get the refund. You can also use a 7200 for advance payments, or even reducing the amount of your payroll tax deposit. So that's one thing I was talking about, that really confusing rule in 2021 of electing to use immediately preceding quarter qualify. So if you know in advance that's something you could look at as well. You have to factor in where you're at, if you have PPP2 to deal with, and 2021 and all of that interaction as well. Another thing that can be challenging is some of you may be using a PEO or a third party, and the process can be a little more complicated with a PEO, with all the grouped employers filing one 941. You really don't have full control of the process as normal. If I just have my business, I'm filing my own 941. The IRS has provided guidance that if you're part of PEO, yes, you can qualify, you can claim the credit, gave some guidance on how that works. But that is what the IRS is telling us can be done. Then there's the practical limitation of working with the PEO to make something happen. One PEO I've been working with several clients is allowing clients to timely claim the credit. So once again, that's the power of knowing in advance if you qualify to claim the ERC on current periods or to not be making deposits. But they are not allowing anyone to make amendments for those back periods. The PEO hasn't. They haven't worked out their process yet to explain what you need to do or what information you need to submit to them to claim the credit. But I promise it's in process and the solution is coming soon. Now, I know some PEOs have worked through the process and have developed the documentation or requirements company needs to submit. But we're waiting to see how some of those PEOs are going to handle this. So it might just take a little bit longer as that extra step in the process to get you your refund or your money back. A couple other things I just wanted to mention that were also added in the latest legislation back in March. So as we mentioned, the credit was extended for all of 2021, but also added some changes for just the third and fourth quarters of 2021. And seeing that the year is almost half over, those quarters are coming soon. So one thing it did is it expands the pool of employers that can take advantage of the credit by establishing a third path that is beyond either the suspension of operations or decline in gross receipts to eligibility. So now so-called recovery startup businesses may also qualify for the ERC. So what is a recovery startup business? Well, it's a business that began after February 15, 2020 and has average annual gross receipts of less than or equal to $1 million. So I think what the government is reaching out and saying, if you're tough enough in the middle of a pandemic to start up a business, we want to help you out. Even though you weren't shut down by a government order or you don't have this look back period to utilize to show gross receipts decline, we want to help you out. So what is that amount that they were talking about for a recovery startup business? So can claim a credit without the suspended operation or reduced receipts, but the credit is limited to $50,000 per quarter. So in third quarter and fourth quarter, the most in credits in total you can get is $50,000. So the most is up to $100,000. But if you start the business, you can calculate the same way as you would under any other scenario, your qualified wages times your 70%, add those up. And let's say you had 10 employees, you paid them $10,000 a quarter, $7,000 per employee, well, you get $49,000. If you had 20 employees and you're getting that $7,000 in credit, or sorry, my math was bad there. 10,000, if you had 10 employees, 7,000 per employee, 70,000 in credit, you're going to be capped at that 50,000. So sorry, making up examples on the fly, it can be dangerous. The other thing that the Act introduced was extra relief for severely financially distressed employers. Those with less than 10% of gross receipts for 2021 when compared to 19. So we're talking about more than a 90% decline in gross receipts. Fortunately, I haven't ran into any clients or businesses that are in that situation, but that was added. And what they were doing there is, even if you're a large, would be considered a large employer, if you were severely financially distressed, they're going to treat you like a small employer, and all wages that you pay qualify. So I know we've been going through this almost at warp speed, a lot of information, and it's, being honest, for a payroll tax credit, it's the most complicated one that I've ever seen. It's one of the most complicated tax legislation and enactments I've ever seen. So this is a super simple case study that I just wanted to walk through to give a little bit of a feel about the interaction of these wages and the PPP program. And so here's the case study, and then a few facts. I did it with a restaurant, bar and restaurant owned by Jen and John, JJ's Restaurant. It's the only business owned by these two individuals, so no aggregation to consider. Hard hit by the pandemic, had partial shutdowns, revenue declines, all of the above. Received PP1 and PPP2 funds. I just made up some covered periods here, and we're looking for, do I have an employee retention credit benefit? So on the next slide, how do we compare gross receipts? So this is where I just wanted to take a moment. You know, it's easy to talk about things, but being in the accounting world and numbers and examples are always the easiest way to visualize some things. So the bar and restaurant was doing fine. We were doing $1 million a quarter in 2019. That was our gross receipts, $4 million total in 19. Well, in 2020, saw a little dip in first quarter. You know, those last few weeks of the pandemic started slowing things down. And then second quarter, really the world changed forever and everything kind of ground to a halt. And then we started recovering a little bit in third and fourth quarter. So as we talked earlier, the test for 2020 is we need a quarter to be down more than 50%. So here in our example, that quarter is the second quarter. It is down 60%. Now, also, we don't have to hit that threshold each quarter to qualify. We only have to be below 80% of our normal, or a 20% decline to qualify once we're in. So the government wants to help us out until we get back to more of a normal level. So second quarter qualifies, third quarter qualifies, and fourth quarter qualifies. So all 3 quarters would qualify for the employee retention credit in 2020. So now on 2021, on the next slide, the same thing is, but the rules are different. So businesses is starting to improve, and we're starting to get a little better. In the second half of the year, we're actually up. So it's what we all want to see, you know, as we've kind of been through this crazy year, that hopefully the second half of this year, things are really turning around and everybody's doing better. So the decline is 20%. So first quarter and second quarter obviously qualify. Third and fourth quarter do not, because we're up, we're not down more than 20%. Now here is where using that immediately preceding quarter can be a big benefit. If we flip back for a second, Amanda, back to the previous slide. In fourth quarter, we are down 35%. And then in 2021, when we go back there, we're down 30 and 25%. We can actually use that 35% decline in fourth quarter, electing to use that immediately preceding quarter, qualify for first quarter, and then use our first quarter decline to qualify us for second quarter, and then use our second quarter decline to qualify us for third quarter. So that if the facts work out for you and you have these revenue declines, it's kind of a way to pick up another quarter, because we'd only qualify for 2 quarters in 2021 with the revenue decline if we're looking at actual quarters. But if we use this alternative election that the government allows us to, we can pick up the third quarter as well, and any wages we pay in that period. In my case, my example, I'm saying it's a restaurant. If I'm starting to get my revenue up, maybe I'm even paying more wages and have more employees in 2021 in that third quarter as well. So the election can really be a benefit for people. So we have these qualified periods, and now how does PPP and ERC work together? So this is a very simple example, and I only have one employee here, just some of its practicality reasons for keeping it simple and being able for everyone to see it on the screen. There would obviously be more employees and data, but this can illustrate some important pieces that I wanted to talk to everybody about. So as I mentioned earlier, you have PPP and ERC. ERC, if you can't double count. So the government, if we're giving you PPP and we're giving you 100% forgiveness, tax-free, we'll give you that dollar, but we can't, on that exact same dollar, they're not going to give us a 50% or a 70% credit on top of it. But you can maximize the two programs together. So PPP is the best thing going still, that, hey, 100% forgiven, tax-free, that's what is the best thing. But ERC is a pretty close second. And if we don't take our time and look at the optimal way to pick and choose which buckets we can put the dollars and these wages in between ERC and PPP, we're going to be leaving money on the table. So this example, I just wanted to illustrate some of that. So I use colors to differentiate the periods. So the gray area is outside PPP and ERC periods. That was at the beginning of 2020, before we had PPP funds or that were not qualifying for ERC. So that's grayed out. So then the next period is, since we're going to qualify for second quarter, third quarter, and fourth quarter, would be, so from the April pay period all the way to the end of the year, could qualify for the employer retention credit. Now, inside that, there's an overlapping period for our 24-week period for PPP in the orange. So only wages paid in that period are available to make up our payroll piece that we need for PPP. And for PPP to get forgiveness, many of you have been through it, you need at least that 60% of payroll costs to get that forgiven. So in my example here, what I did first as my optimization was, okay, I want to get as much ERC as possible while preserving as many wages for PPP. So qualifying the $2,300 for Betty the bartender here for the pay period in April and May, because I can't use that for PPP anyhow. Same for November and December. So I took $2,300, which is the wages, plus what the employer was paying her as insurance that qualifies. So that's kind of what my qualified wages can be for the employer retention credit is. So, well, that gets me to $9,200. Well, I want to go ahead and max that out. So where do I get the other $800? I picked it out of the next pay period and took $800 towards ERC and moved it out of that PPP bucket. So there's nothing magic about it. You can pick it out of October or anywhere else or separate periods. So that'll get me to my $10,000 cap of the most wages I can qualify for in 2020. It's for the whole year. I can only use 10,000 per employee. So that gets me 5,000 in ERC credits for Betty, but it also leaves $10,700 of wages for PPP. Now this assumes that I have plenty of wages between Betty and everyone else in that PPP bucket as I add them up to meet whatever I need for PPP. Now, if I needed more to get full forgiveness, I'm not going to take a 50% credit for ERC and then pay back my PPP loan. I can optimize that number and toggle back. If I need, let's say I needed $500 more for PPP, instead of $800, I'd move that $500 back to PPP and only have $300 in that ERC. So this is something I've really been working with a lot of clients with in the last several months. We built a model to optimize the interaction between these two programs. Now, some of you don't have PPP2, didn't have PPP funds. That ERC, it's a simpler calculation. You don't have to worry about the interaction of these two. Now, there are interactions with other credit programs that you can't double count as well, that we have to work through. But a lot of people that I've been dealing with have received PPP funds and can also get full forgiveness of all PPP. And in many cases, I just finished up a client yesterday, their ERC benefit is greater than their PPP benefit. So they're able to take both, take advantage of both programs, and it can be really powerful. So that was a simple example of how the ERC and PPP work together. Now, if somebody went through this and just said, okay, I'm going to take ERC, I'm going to maximize that and just do it chronologically, Well, then you would have moved these $2,300 up into the PPP program, and you would be $4,600 short or have that much less in PPP. So there is some time that is going to be required to make this happen, and optimizing takes some time, some knowledge, some expertise to make it happen, but it can be very powerful and seeing how the two programs work together. So that was just a little example of trying to pull this together. I'm looking to see if we have a few questions here that maybe we can answer. Somebody typed in, I don't know, Tim, I haven't been able to look at the questions too much as I was talking. But
So one of the questions, we talked about documentation requirements. Could you talk a little bit about what the documentation requirements are for the program?
Sure. So the documentation requirements, and the IRS published in the notice that, hey, what is your documentation? So you're going to have to prove your eligibility. So either prove out your revenue decline, or if you have a partial shutdown or full shutdown by a government order. So you're going to have that documentation tying back to a government order to say, oh, okay, that's why I was shut down for these periods. And then your calculations of proving out, okay, these are my wages from my employees by period. Here's the health insurance benefit. And then also you're going to have to show the interaction, that you're not double counting with PPP, not being able to double count with, family first medical leave credits or any of those things. Another question that I get a lot is the question about how long does this take? If we're talking about getting our money back, I want to do a 941X, 2020. How long is that going to take me to get my money back? This is one thing that I've always been warning people about. If you get used to the PPP world and working with the banks, how efficient that was, that, hey, in 2 weeks, you're going to have the money in your bank account or deposit. This is not that program. So if you're filing those refund claims, it may take a long period of time to get all of that through the process. It might be months, so to get your cash. So that's one thing that a lot of people ask about. See if I can open up this question tab.
John, you mentioned earlier in the presentation about federal or state mandates to shut down. I'm assuming you said government use, so like local jurisdictions, counties, cities, that would also qualify, because sometimes they were more restrictive than state or federal.
That's a great point. Yes. So it's government orders, and it can be, the local or city coming out with something as well, but it has to be an order, something that is forcing you to. So the IRS also provided guidance. So CDC recommendations are not an order saying, hey, we recommend people do this. But if it's not something that is being forced upon you in your business, it's not really meeting that level of what is a government order forcing you to be shut down.
So John, does it matter how you applied and got forgiveness for PPP in terms of maybe what kind of covered period you used, and how does that play into your calculations?
So there's some guidance for that as well. For 2020, many people did this, that, okay, I'm not even worried about the 40% bucket. I have enough payroll to cover it. I'm just putting that in. As we can see, when we're trying to, in that example, put things in PPP bucket or the ERC bucket, there's power in maximizing the non-payroll bucket. So to preserve as many wages as possible for ERC. So now that we know that, especially in 2021, if you're going through PPP2 or one as well, if you can put something in that 40% bucket, you get to preserve more wages for ERC. So what the IRS came out and said is, if you put in your application, let's say, I always use numbers as an example. If you have a PPP loan for $1 million and you had 1.2 in wages that qualified for that period, and that's all you put on your form, even though you maybe had $400,000 of other expenses and rent, utilities and everything. You didn't put that on your forgiveness app and you got your loan forgiven. They're not allowing you to go back and say, well, I use that 400,000 that I could have more wages. But what they are doing is saying that headroom that you have is available for ERC. So if you use 8-week or 24-week or whatever period you did for that, those wages are going to have to be applied to the PPP loan. So unfortunately, if you've already done that, you may have left some money on the table, but in a lot of cases, there's still a lot of benefit there, no matter how you did your PPP forgiveness.
Yeah, what about, we have a lot of clients that maximized the employee part, the wages, but not the health benefits part of it because they didn't need that. So would they still be able to take the health benefit portion of the pay to apply towards the ERC?
Yeah, so now, just to make sure we're clear as well, that for PPP, what qualifies for payroll is different than wages. So there's some things that qualify for PPP, such as 401k contributions and state and local taxes and things like that, that don't necessarily qualify for this program. But let's say somebody, back to my example, had $1 million PPP1 loan and they put on their 1.2 million of payroll, and that was just straight payroll. They didn't even bother with health insurance or anything else. All that the government is saying, at least $1 million of that has to stay for PPP. You can pick and choose which employees that comes from and everything else. So if you have an employee, like I was talking earlier, that's related, that nephew, will use his wages all into PPP because you're not going to qualify for ERC. And then if you have employer paid health insurance that, let's say it's $100,000 for that period, you can pick that up for ERC as well.
Does it matter whether you're using the 20 or the 21? The same rules apply to both calculations?
The same rules apply for both calculations, but we all know now. So as we're looking at PPP2, the unfortunate thing when they retroactively changed this, people were going ahead and putting in their PPP applications like, well, it's just easier. Why do I need to dig up all this other documentation? It's not going to change anything. And some people hope that the IRS will be like, well, we understand that. Give us the documentation now, and then you can use that for ERC. But they didn't go to that level. Some of it's probably for administrative burden for them. But as we're looking at in 2021, PPP2, or if you had your forgiveness apps put in, take the time, if you're going to qualify for ERC, to maximize that 40% bucket, because in my example, I keep going back to this $1 million example, if you had 40% of other costs and you're only going to need 600,000 of wages, well, you just freed up 400,000 in wages. And maybe the math doesn't work perfectly out, but if all of that is credible in 2020, you're talking about $200,000. I mean, it's a huge difference. And that's the thing as we're looking into 2021, how these programs interact is even more complicated because the cap is per quarter, and which quarters you qualify matter, and really laying it out and saying, okay, here's my 24-week period, here's my qualified expenses, how can I maximize what I have headroom on for ERC and make sure I get all the ERC benefits in my qualified periods.
So summary, if you haven't applied for forgiveness yet, you want to maximize your cover period and maximize all the related expenses, and like 401k and everything. So you want to allocate because there's a difference of what qualifies, right? So whatever qualifies, you want to get the data into your forgiveness for PPP.
Right, and some people, especially since they expanded some of the buckets for PPP2, and as we go forward, that you get over that 40%, there's easier things to document, bigger chunks. But yeah, I really encourage people, two things for 2021, especially when you're looking at ERC, is use the full 24-week period. That gives us the most flexibility, and we can pick and choose. I can fill it up, in the first 12 weeks, if that's how the math works out best for me, or pick and choose. But if you use your full 24-week period for your forgiveness, that gives me more flexibility when I'm doing my allocation for you and your ERC benefits, what bucket I'm putting cost in, and then maximizing that 40% bucket to really give us the best chance to maximize your ERC benefit.
Right. I think, John, that wraps up. Other than, this is really complicated. What's your recommendation for clients, talking to a professional, calling you?
Yeah. So, I mean, this might sound like a sales job, but it is a complicated thing. It is in the interaction with the programs, other programs, in making sure that you don't leave money on the table. It's very easy to go through and do a simple calculation and maybe you get 50% of your benefit or something like that. But to really optimize the program and to document it to withstand audit, you really need help. I think it is there. And if it's me or Brad Smith Wallace or one of your other trusted advisors, I recommend you having a conversation with somebody, seeing what your options are. Now, there are, like many things, there's a lot of money out there. This is new. There are most people are good actors. If people are coming to you and that you've never met before and saying, hey, sign this piece of paper for a huge contingency fee, I'll take care of you. Take a moment, truly understand what they're going to do for you, truly understand what you're signing yourself up for. Glad to have any conversations with any of you at any time about those. But I do recommend people to take a second look, even if you've looked at this and like, oh, okay, I don't think I qualify. The money is so large. Take a moment and really consider, do you qualify? Reach out to a professional, me or anyone else, to have that conversation, because it doesn't take anything to get into six figures and a lot of times into seven figures in benefit. I had a client that I finished their calculation this week. They had 26 employees. I did their 2020 calculation. It was $117,000. Full PPP forgiveness, everything else. $100,000 moves the needle. And then when you start getting into 2021, especially for people that are qualifying their 300, 400 employees, and then some of the larger businesses, you get into those seven figures real fast.
Well, thank you very much today, John, for your expertise. You made a very complicated legislation a little easier to understand, at least to understand, do I qualify and how do I take the next step? So thank you very much for that today, John. I want to end it with just a reminder that we do have another webinar coming up on ransomware. Could your business be next? That's going to be June the 15th. You should have invitation to that already. This is a really hot topic right now. I think when in recent times with Colonial Pipeline, and if you saw the news today, JBS, the world's largest meatpacking company, is being held ransomware right now. And these are really impacting a lot of supply chains. But I think you need to be aware that this is not just impacting, we hear about the big businesses that is impacted by this, but we don't hear about the smaller businesses, and there are indeed a lot of smaller businesses that are impacted by this. So please be on the lookout for that. Thank you for your time today, and I'll hand it back to Amanda.
Thank you, Tim, and a special thank you to our special guest today, Jason Schwartze. And please do take a few moments to complete the survey that is available for you after this webinar. And thank you, and have a great day to everyone. Enjoy your day.